Emerging markets represent some of the most dynamic engines for global economic expansion. These rapidly industrializing economies offer a scale of growth that developed nations simply cannot match. When investors look to capitalize on this expansion while managing the inherent volatility, they often rely on a familiar strategy: hunting for high dividend yields. A quarterly cash payment provides a tangible return and creates a sense of safety in otherwise turbulent markets. But chasing those high yields often leads directly into value traps. In many cases, these companies are paying out more cash than their balance sheets can actually support, masking structural decay with an attractive dividend check. To gauge the actual health of a business, we have to look past the visible dividend and examine its total underlying free cash flow. The Cambria Emerging Shareholder Yield ETF, trading under the ticker EYLD, acts as a quantitative sieve built around this exact principle. It is designed to screen the emerging market universe to find companies generating true sustainable value. Navigating these economies requires abandoning the basic dividend metric and adopting a far more ruthless evaluation of corporate health. That evaluation takes the form of a strict quantitative funnel. The process begins by casting a wide net across the vast and noisy universe of all emerging market equities. This visual shows the first filter in the algorithm: cash dividends paid. Next, the formula expands to include net share repurchases, a tax-efficient way to return profits. Finally, it screens for net debt paydown, a mechanism that fortifies the company's balance sheet. Combining these three metrics, dividends, buybacks, and debt reduction, gives us what is known as shareholder yield. This provides a holistic, clear view of a company's true cash-generating power. As a final step, the algorithm applies value and momentum screens. This isolates only the top 100 strongest stocks, ensuring the portfolio is positioned in companies with strong fundamentals and positive price trends. By applying this multi-layered screening mechanism, the fund strips away speculative traps and leaves behind a bedrock of proven cash-generating engines. We can see the results of this rigorous screening process by looking at the actual geographic allocations that survive the cut. The portfolio reveals a heavy geographic concentration, with a massive 24.7% allocation anchored in Taiwan's industrial and export markets. This is followed by a secondary regional concentration, with 16.2% of the fund allocated to equities based in China. Looking at the sector breakdown, the fund leans heavily into financials at 27%. This specific geographic and sector footprint is the strict mathematical output of the shareholder yield philosophy. Checking the fundamental vital signs of this portfolio requires looking at both its underlying valuation metrics and its operating costs. To maintain this active screening architecture, the fund charges a gross expense ratio of 0.65%. This chart shows how that cost compares to performance metrics. EYLD delivers a 9.8% median shareholder yield, dwarfing the MSCI Emerging Markets Index at 1.2%. The price-to-earnings ratio for EYLD is 10.60, a notable discount compared to the index's 16.64. The math indicates that the fund successfully secures cheaper, higher-yielding assets than a standard emerging market benchmark. This strategy benefits from certain macroeconomic tailwinds, notably a global shift toward value investing, and the growing realization that tax-efficient stock buybacks often outperform taxable dividends over time. However, deploying capital overseas means navigating the systemic storm clouds associated with any emerging market strategy. Investors face specific external threats, including severe currency fluctuations, lower equity trading volumes, and the constant friction of geopolitical instability. There are internal risks as well. Underlying companies in these regions could be operating with heavy, undisclosed leverage, or they may simply elect to reduce or cut their dividends at any time. Even a perfectly engineered algorithmic funnel cannot entirely shield an investor from the inherent sudden volatility of emerging markets. Yield represents a complex architecture of cash flow, encompassing buybacks and debt retirement alongside quarterly distributions. The bull case for EYLD is clear. It offers a highly engineered, lean vehicle that mathematically targets companies paying down debt and buying back stock at deeply discounted valuations. The bear case is equally straightforward. This is an actively managed ETF carrying a 0.65% expense ratio, heavily concentrated in Taiwan and the financial sector, operating in one of the most volatile regions of the global economy. The choice comes down to whether the rigorous math of shareholder yield outweighs the geopolitical risks of the emerging market. If you found this breakdown helpful, please like and subscribe to Stocks Simplified. Remember, investing involves risk, including the possible loss of principal. This video is for educational purposes, not financial advice. Carefully consider the fund's investment objectives and risks before investing.